I call the Chancellor of the Exchequer.
Welcome to the Tax Factor Autumn Budget Special.
On July the 4th, the country voted for change. This government was given a mandate to restore stability to our economy and to begin a decade of national renewal.
The Tax Factor from Blick Rothenberg. This week with Heather Self and Robert Salter.
Welcome to The Tax Factor, the UK's top tax podcast. I'm Heather Self.
And I'm Robert Salter. It feels like we've been talking about the budget for weeks, and we have. It's been one of the longest gaps between an election win by the opposition and a budget announcement, nearly 16 weeks. Although you could be uncharitable and say that they've spent most of the last few weeks leaking the detail, bit by bit. So Lindsay Hoyle certainly thought so in Parliament this week when he said the premature disclosure of budget by the Chancellor was totally unacceptable. Pity they don't do anything about it beyond saying things. But here we are. It's finally all out in the open. And what have we got? Heather, what do you think about the budget?
Well, let's just start with the general perspective. I think Rachel Reeves has an unenviable task in that the economy isn't doing brilliantly. Public spending clearly needs more money putting into various services, and yet people don't want taxes to go up. And I think one of the worst things that the Labour Party did was to put in their manifesto that they wouldn't raise the main rates of income tax, national insurance and VAT, because that means they've somehow had to square a very difficult circle. So she's not coming into a great place. She needs to spend more money. She doesn't want to borrow too much and have a quasi-Cartang car crash, but she's got to raise taxes, and that's what she's done. It's an enormous overall raise in taxes, at just over 40 billion. That's actually more than the 1993 Norman Lamont budget, which I think was about 38 billion. So this is a big tax-raising budget. She's taking a gamble that the money that they're going to pump into the NHS and other places is going to have a real and quick impact. And she's really hoping that we get economic growth. Although it's interesting that the figures that the OBR has put out are not predicting very stellar growth over the life of this Parliament. So this is not going to be rainbows and unicorns anytime soon. Today, we're not going to talk through everything in the budget. Apart from anything else, you don't want us here for an hour and 20 minutes. But what we thought we'd do is give you our views on some of the big measures. And Robert, the big one is the national insurance. What's your thoughts on that one?
I agree that it's certainly the big one in terms of, the 40 billion or so that they are looking to raise from the budget. Perhaps 50% of it will come from changing the employer NIC rules. It is actually, I think, quite a bad measure. I think in many respects it will start to reduce pay for people, for example. So the idea that she hasn't laid taxes on working people, clearly in an official headline perspective, that's a valid comment. But from a back of the door perspective, people will suffer lower wages. Potentially you'll have less employment in terms of some jobs may be outsourced or offshored. You may try and use technology to replace jobs and things like that. So it's certainly going to hit working people at the end of the day. And, that was what she was claiming not to do. So I think in that context, it's quite poor. And certainly for the short term, at least, things like bonus pools will be impacted. So people will lose out in that way. And there will be a real cost to employers. Somebody on 100,000, potentially the company's going to be paying 13% more for that employer social security. So again, it's quite big numbers there. So it is quite a kind of a nasty thing in that regard.
I think smaller employers are going to be quite well cushioned by the employment allowance. That's been increased from £5,000 to £10,500. And also the cap at the eligibility limit has been removed. So if you employ up to about 8 or 10 people, you're probably going to end up more or less neutral. The people I'm concerned about are the ones where they're very labour-intensive industries. I'm thinking of supermarkets, hospitality, care homes. Even there's a charity I'm a trustee of. We've got 200 employees. That's going to cost us something over 100,000 next year. That's a big sum for people to have to find.
It is a big sum, and certainly for some businesses, they may be able to, for example, increase their prices and cover the costs that way. But then that pushes up inflation, or was another factor that could push up inflation. And obviously in some sectors, you may not be able to push up your prices particularly quickly or at all. They may be very price sensitive. There's going to be some businesses out there that are going to be in a really, really tight bind. And like I say, things like hospitality, to some extent, they're already struggling with the cost of living. Then they've got higher costs now. So it's kind of like a double whammy for them, I fear.
Plus the increase in the national minimum wage. So there's a lot of costs being loaded onto employers, which I think we all think are going to pass through to employees. Just one thought I had about this reducing the lower limit. So national insurance for employers is now going to start at £5,000 rather than £9,100. What I think that will also catch is the people who have 2 or 3 part-time jobs. At the moment, national insurance is charged per job and not per person, unlike pay as you earn. It would, of course, have been much better to do some work on aligning national insurance and income tax. Instead, what we've got is, frankly, a fudge because of the manifesto constraints. It's something which is going to be a direct tax on labour. Pensioners are not going to pay it. I'm quite happy about that at my age, but actually, is it good policy? No, not really.
No, it's bad tax policy. It's inconsistent. It's just complicates the system even more. And let's be honest, a good tax system is generally a simple tax system. That's not what we've got at the moment.
So moving on to something else which is definitely not simple, the abolition of the non-dom regime. Just a warning here, there's 103 pages of detailed draft legislation, which neither Robert nor I has read in detail yet. I think this is very much a political move and one that's not unexpected. The thing that did surprise me was the assumption that it might raise 12.7 billion. I'm really not convinced. Are you?
I would be surprised if at the end of the Parliament it's raising £12.70, to be quite honest, let alone 12.7 billion. I think, the reality is the nature of non-doms is that they are flexible. They can generally move quite easily. And whilst the UK is, kind of changing the non-dom regime, in fact, they're moving it, a lot of other countries in the last few years have actually created their own alternatives to the non-dom regime. And, they are quite attractive to some of these individuals. And you want to go to Italy, lovely place to live. Okay, the admin might be questionable, but it's a very good non-dom regime. And there's quite a few other places out there which are kind of equally attractive from a lifestyle perspective. So I think it's the sort of thing that, yes, from a headline perspective, you think if everybody stays, you get this money. But the reality is some people will go and you probably won't get other ones coming. So it's kind of that double whammy, I'm afraid.
The other thing which was very well trailed, publicly announced before the budget, was the VAT on private school fees. I think we'll skip over that one today, Robert. We've already talked about it quite a bit, concerns about the admin, particularly with it coming in partway through the school year, but there was no way they were going to back down from that one. What we've also seen, which we were half expecting but didn't know any detail on, is changes to capital gains tax and inheritance tax. Capital gains tax changes, probably not as bad as the rumours had suggested, I would think.
I would agree. They're definitely not as bad as people feared, or at least some people feared on occasions, given the hearsay that was coming out and everything like that. But I think still definitely an increase in capital gains tax. And certainly, given that we include inflation within the capital gain that you're paying tax on, you could argue it's unfair. It's simple, but it is unfair.
Personally, I'd rather have a roughly reasonable rate and no indexation allowance than go back to the very, very complicated system we had a few years ago. Worth saying that the changes to capital gains tax will apply for disposals from tomorrow. You're not able to wait until the 5th of April for that. However, slightly surprisingly perhaps, they've retained the £1 million of business asset disposal relief. So the first £1 million is still taxed at 10% up until the 5th of April next year. Then it will go up to 14%. And then the following year, it'll go up to 18%. I think we might see a few people rushing around seeing if they can get disposals done before the 5th of April, Rob.
Agreed, although again, there's that kind of common sense position. Do you sell now and try and get a lower rate, but perhaps rush through your sale, not get the full value of the business and things like that? So there's going to be a bit of a conflict there for owners in terms of what's the better option. Absolutely.
And the other change on capital gains tax, as expected, they're increasing the rate of tax on carried interest. But I think the way they've done it's really complicated, isn't it, Rob?
It is really, really complicated. So in effect, they're now saying that the kind of money you make from carried interest will be, in effect, self-employment income, self-employment profit, but not taxed as normal self-employment profit at, 40% or 45%, but at a percentage of that normal rate, 72.7% of the normal rate, and then liable to NIC. So it kind of gives you a potential tax rate of 32% plus the NIC, so 34%, which is give or take what's in most European countries. But it's a very complicated, slightly messy, kind of quirky system and way of doing it. So, yeah.
That's an odd one.
I think there's going to be
it?
a lot of detail in the legislation and we're going to have some headaches, I fear.
And that, again, is going to apply from the 5th of April next year.
Yes.
Presumably because people don't have much control over when they realise their carried interest gains. It's not like selling shares where you can just decide to do it next week.
No, these are things that they're often having for 5 or 10 years before you actually get the money anyway. So there's not that much flexibility about what they do with it. And certainly the average PE executive, he might get a lot of money from it, but he's not a major shareholder or anything like that.
Inheritance tax changes, relatively minor, keeping the thresholds the same. They're being frozen for another 2 years. So it's still 325,000 with an extension for 500 for the principal residence, but restricting some of the reliefs, particularly agricultural property relief, business property relief and AIM shares. Any views on that, Rob?
Certainly the AIM shares one is I'm I must admit, being slightly surprised about, because AIM as a market is actually struggling a wee bit. In fact, the stock market in the UK is struggling a wee bit generally, sort of thing. And so the fact that, okay, you still get some relief for AIM shares, but it's only going to be in effect at 20%. I think that's still going to be slightly worrying for people and worrying for the market. And, if we're trying to get more investment in the UK and more listings in the UK, will it undermine that? Possibly.
I don't know. I think the thing with inheritance tax, there are a lot of people who don't pay it at all. It's only about 6 or 7% of estates that pay it. And then you get the next band, which are people who typically have an expensive house and some savings, and they're paying inheritance tax but don't do much about the planning. And then the people who do a lot of planning are the estates above, I think it's above 9 million, where a lot of planning goes on. And really, I don't have a major problem with restricting the release for those people who've got plenty of money.
The only other thing, though, I would think from the IHT changes is that, for example, pension funds or pension kind of annuity funds, not the annuity funds, but the money you've kept in your pension fund, you haven't withdrawn it yet. That's now going to come into the IHT estates. That combined with the fact that obviously you're keeping the thresholds until at least 2030 now, I do think the absolute kind of pool of people caught by IHT will go up significantly in the next 3, 4, 5 years. So, and it's a very unpopular tax. Now, obviously, any tax is unpopular. Or it's any tax that you have to pay is unpopular. Any tax other people pay is often more popular. But like I say, a lot of people, even when they're not caught by IHT, have always been kind of quite emotional about it, thinking it's unfair or whatever. So politically, it could be quite damaging if they're not careful, if things work out badly.
I think the biggest surprise for both of us, Rob, was probably the fact that fuel duty has been frozen. I'm actually quite cross about that, because when the 5p temporary reduction came in a couple of years ago, petrol was about 190 pence a litre. I filled up my car yesterday. I usually do it the day before the budget, and I got my petrol at 129.9 pence a litre. That's 60 pence less than it was. Surely she could have put the 5p back on and probably raised it by inflation as well.
I'm surprised they didn't put the 5p back on and actually raise it further, because obviously, they talk about being an environmentally friendly party, about green taxes and things like that. And it's a relatively natural green tax to focus on. And as you said, they are in petrol prices at the moment, diesel prices are cheap compared to what they were 1, 2, 3 years ago. I think the fear is now that they've given this break here, will they ever be able to raise it again in this parliament? And so you're potentially kind of undermining the move, for example, to hybrid cars, electric cars and things like that at a time when we probably need to be pushing that move. Slightly surprised by that move, very surprised by that move, to be quite honest, not just slightly, very surprised. And I couldn't really see the logic for it.
No, it seems to be 3 billion that was being spent for no good reason. She could have kept the bus fare cap for less than that, and that would have been much more popular, I think.
Or winter fuel payments.
Or winter fuel payments, absolutely. So just as a roundup, just a couple of other points to mention. We did get the corporation tax roadmap published. Very pleased to see that. I have had a look at it, and I'm pleased to say it's quite boring. It just tells you all the things they're not going to change over the life of this parliament. But I think that's a good thing. It's going to give some stability for business. And one other thing which I think is popular with us, we always find a way to mention the high income child benefit charge. There was a proposal to move that onto a family basis. And while that might seem fairer, it was going to be awfully complicated. I'm pleased to say I got as far as page 144 of the Red Book, where they've confirmed they're going to drop that idea. So we've had a quick canter around what's in the budget. What's your overall view, Rob?
Most of the things I think are as expected. Like I say, I think the saddest thing, though, is that there's not a real strategy there. There's no obvious strategy there. Obviously, we have the corporate tax roadmap, and that's something to be positive about. But some of the tax anomalies in the system, for example, aren't really being addressed. Whether that's the universal credit kind of charges that you can get 55% or higher rates when you're kind of working extra hours, or the 62% that you have between 100 and 125,000, things like that. None of those have really been addressed, and there's no kind of clear sense that the government is focused on them or worried about them. And they do create negative behaviours by people. I know when I've spoken to my GP, the reason she works 4 days a week rather than 5 is because she can get free childcare working 4 days a week because her salary is below a threshold. Yet we desperately need GPs to be available as often as possible. Things like that have negative implications. So I think that's sad.
I absolutely agree with you, Rob. I mean, clearly, as we said at the beginning, this was a budget where she was facing a difficult economic landscape. She did need to raise taxes to pay for better services. It remains to be seen whether we will actually get better services. The amounts being promised are large in the next year or two, but still quite tight budgets on departmental spending beyond that. But overall, this was a budget to raise lots of money with 1 or 2 big measures and some smaller ones. It's putting some more money into the economy and changing the borrowing rules. But it didn't feel like a budget that's taking a strategic look at the tax system. And whatever you thought about their politics or their policies, Gordon Brown and I think if you go back further, Nigel Lawson were were really reforming chancellors. As the first woman chancellor for 800 years, I was really hoping that Rachel Reeves would come in with a real vision for the tax system, and I don't think we've seen that yet.
No, and especially given that she was such a fan of Gordon Brown, who was, her hero politically and things like that. She would have hopefully learned some of his lessons in terms of, having a clear plan. And let's be honest, she had plenty of time because it was reasonably clear from at least the Kwarteng budget that it was going to be a Labour chancellor coming in. It was realistically going to be her. So I think she's had the time to do much more planning and have a real kind of idea of where she wants the country to go. And that hasn't been seen today.
No. And on that note, I commend our budget commentary to the House.
The Tax Factor Autumn Budget Special.
If you are all budgeted out, we've just released a new episode of our sister podcast, Brave Business, presented by broadcaster and journalist Declan Cully. In this episode, we are looking at the topic of global talent. How do you attract the best talent for your business, particularly when you grow internationally? Which approaches work well and which do not? And how will technology, particularly AI, impact a global workforce? Joining Declan to discuss all of this are Blick Rothenberg's Head of Global Mobility, Hannah Earle, with guest Gareth Wadley from the law firm Bristow's. Like the Tax Factor, it is available on all podcast platforms and on our website.
We release a new episode of The Tax Factor every Friday on the Blick Rothenberg website and on all the usual podcast platforms, so you can listen wherever is most convenient. We record and release them in less than 24 hours, so you always get the very latest news and updates. If you enjoyed the podcast, please subscribe and give us a rating or review. Next week, Nimesh Shah and Roger Holman will be in the hot seat. I'm sure both of them will have plenty to say about the budget once they've had time to digest all the detail.
But from us, it's goodbye and have a good weekend.
Goodbye.
On these benches, commend those choices, and I commend this statement to the House.
That's the Tax Factor. We'd like to thank you for making us one of the UK's top 20 podcasts. Find all our previous episodes wherever you get your podcasts, and join us again next time on the Tax Factor.